If you've had a very good profit during the week, you bought the S&P when it was at this low, you want to sell on the Friday so you don't hold over the weekend. The fact that gold is continuing to move up today, I think, is a compelling sign.
Adrian Day discusses how the Fed cannot control inflation and prevent recession at the same time. He also mentions that the impact of rising rates has not yet been fully felt.
My answer always was that gold will start to move when people realize that the Fed basically can't control. The Fed can't kill inflation and stop a recession at the same time.
No, it seems, as you mentioned, and as you've mentioned before previously on interviews with us, the impact of rising rates has not yet fully been felt. And it seems like rising rates were a significant factor of Silicon Valley Bank going under because they had to sell their treasuries at a loss.
He also talks about how there are institutions like banks, insurance companies, and pension funds that will be hurt by the rise in rates.
Do you see further bank failures or further issues in the system based on the Fed just continuing to hold to high interest rates?
Yeah, I don't know enough about the banking system to make a rational, sensible analysis there. But there's no question that there are institutions out there, whether they're banks or insurance companies or pension funds or whatever, there are institutions out there that will be hurt by rising rates. No question about that. And we talked about the lag and things like housing and automobiles. The impact is seen immediately because they're very, very interest rate sensitive. But again, just what I said about Silicon Valley, how you buy bonds, but if you hold them to maturity, you don't have to mark to market. So the deterioration has been happening over the last 9 months while rates are going up. But the impact isn't felt until some event, which someone starts taking their money out. They get more money taken out. They have to sell some bonds. They sell them at a loss. And that's what we're seeing now.
Adrian Day explains that there are problems in the system that are not yet being seen, but there will be if interest rates continue to go up or stay high for a long time.
I think there are enormous problems in the system that we are just not seeing at the moment. But if interest rates continue to go up or continue to stay high for a long time, remember Powell's been talking about we may not continue to raise for much, but we'll have high rates on a consistent basis, persistently high rates, we're going to start seeing trouble. And again, you only have to think of a corporation. A corporation that borrowed a lot of money when rates were at zero. So a good quality corporation maybe borrowed at 5% or 4.5% or something. And then they did certain things with the money. Maybe they bought back stock. But whatever they did with the money, they didn't sit it in a bank account, a money market fund. It's gone. It's been spent somehow, whether for good reason or for bad reason, on capital investment, an acquisition, whatever. And so when that bond matures, they're going to have to roll it over. Most corporations are going to have to roll that money over. That's not going to happen for another 12 months, maybe. But the problem is still there. And we're going to have fundamental problems with marginal companies if rates stay where they are.
No, it seems like what we're seeing as well is there's a flight to safety among investors to gold. Gold is 50 as we record this on Friday here. Here at Miles Franklin, we've seen incredible demand for the physical metal.
Adrian Day talks about how people are moving out of banks to treasuries, money market funds, and other safe assets. He also mentions traditional safe haven currencies like the Japanese yen and Swiss franc.
Your perspective on this, how people are seemingly trying to get out of the currency or get out of the banks and fly to safe havens.
Yeah, I think there's two things going on. With regard to the stock market, there's still a great deal of complacency, but there's certainly an increased desire for some kind of insurance. And there's definitely people moving out of banks. They've been moving out of banks to even treasuries, because you can get more money on a treasury bill than you can on a bank CD. So people are moving out of banks to treasuries, money market funds. But they're also, as you say, clearly putting some money into gold and other safe havens.
Adrian Day discusses the Federal Reserve's actions on quantitative tightening, QT, and its balance sheet. He believes that the Fed's actions were not particularly aggressive and reminds him of the actions taken in September 2019. He also notes that the Fed has only one medicine, which is to ease money, and that they cannot kill inflation or stop a recession. Adrian Day also believes that gold will continue to be strong, and there is potential for a significant inflow into the market.
These things never go up in a straight line, of course. I've been saying for a year now, when people have been asking me why hasn't gold moved more with inflation and everything else? And my answer always was that gold will start to move when people realize that the Fed basically can't control. The Fed can't kill inflation and stop a recession at the same time. And I think we've reached that point. It's pretty clear when you saw what the Fed did last weekend. Basically, in 10 minutes, they wiped out half of the QT that they've been doing in the last 12 months. And they hadn't really been doing that much to begin with. The Fed balance sheet was just a little under 9 trillion. They didn't even bring it down to 8.3 at the low. That's less than 8%. When you think that the Fed balance sheet was less than 4 trillion, that's less than half only 2 years ago, 3 years ago now, 2.5 years ago, 3.5 years ago, sorry, 2019.
He discusses the strength of gold and investors' underweight position in the U.S. Adrian Day believes that gold will continue to be strong due to cracks in the system and issues in the banking sector. He also notes that investors in the U.S. are very underweight in gold, and even a small increase in their allocation can lead to a significant inflow into the market.
I think gold is going to continue to be very strong for that reason. And again, as we know, investors in the U.S., institutional and retail, tend to be very underweight gold right now. So the potential for institutions in the U.S. have about 0.5% of their assets in gold. Long-term averages are between 2 and 4%. So even if they go from 0.5% to 1%, which will still be under half the long-term average, that's a significant inflow into the market.
It is very significant. And as we're talking about how there's definitely cracks in the system right now, I'm seeing that even First Republic Bank is having issues, it sounds like. So that's number 5 on the list there after Credit Suisse. But if we continue to see issues here, and you're saying that also the stock market is showing surprisingly good strength right now, even though there's issues. If we do see a rollover in the stock market, do you anticipate a momentary pullback in the gold sector and the miners?
Yeah. I wouldn't be surprised looking at it right now. You look at how much gold has gone up in, where are we? Just in the last 3 weeks, it's gone up about 17%. Again, things don't move up or down in straight lines. So I think we would have to say that gold is vulnerable to a pause. I'm not sure we're going to get it immediately, frankly. The action today is very telling because often on a Friday ahead of a weekend, people like to balance their books a little bit, and they like to lock in profits. If you had a very good profit during the week, you bought the S&P when it was at this low, you want to sell on the Friday so you don't hold over the weekend. The fact that gold is continuing to move up today, I think, is a compelling sign. We don't know what the Fed's going to do next week, frankly. I have my guesses, but there's always a possibility that they'll raise rates, and Powell will be very hawkish in the press conference, saying inflation remains the number one issue. That would probably see gold come back a little bit. But with regard to the stock market, if we see a sharp, short-term sharp decline or crash, whatever you want to call it, in the stock market, then history will tell us that the gold stocks will come down as well. But history will also tell us that the gold and the gold stocks tend to be the first to recover after a market decline. And I don't know if we've talked about this before, but if you go back to 2008, the gold stocks actually were falling before the S&P. The gold stocks bottomed before the S&P bottomed, and the gold stocks were already up. They were already up by 100% before the S&P bottomed. And that's a typical pattern. We saw that in 1987 and so on. So if they do decline, they will probably bounce back sooner and faster.